Thanks, Prashant. Mark, that's the question. India's peak valuations were 22 and a half times. And today, according to some estimates, we are at 22 and a half times in terms of price value. Some markets have yet to catch up. China has to catch up and Australia has to catch up. So do you think that puts India at a disadvantage after this ascent to 13,000 on the Nifty?
Well, one always likes to buy cheap, and I won't deny that stocks around the world, including in India, are not cheap. But you're comparing today's valuation to a long-term average, which is probably not appropriate given where interest rates are, because the last time India got to 22 times, I don't know when it was, but I imagine interest rates were much higher than they are today, and that's the same around the world. So there's no doubt that stock valuations would not be this high if it wasn't for interest rates being so low. But I think we can say pretty safely that interest rates won't go up all throughout next year at least, and then maybe if the economy is really rip-roaring in 2022, we can start to contemplate higher rates. Although the Fed itself is guiding for 3 years of no rate hikes. They can always change their mind if the economy stages a really, really strong recovery. But anyway, that's my answer to your question, is that, yes, I won't deny that prices are expensive in stocks, but that's because interest rates are low and they're going to stay low.
Mark, good morning. So in that case, can that push Indian markets to perhaps exuberance territory? Because, in this month, India has got the highest inflows Asia ex Japan. A lot of this could be passive because of the MSCI weight increase, but still, we've got about $7.5 billion in a single month.
Yeah, I think for the next 3 to 6 months, the outperformance will come from the companies that didn't do well over the last few years, the cyclical and value kind of stocks. And it will in almost all markets in the world, because right now the correlation between value and growth is at an all-time low. And if you look back in the past, over the last 30 years, whenever the correlation between value and growth was very, very low, the value stocks outperformed the growth stocks over the next 3 months. So we think this catch-up in value and cyclicals has more to go. And so, what makes the Nifty, for example, expensive is probably Reliance, and the other big growth stocks that have propelled it higher this year. The cyclical and value component of the market is, I think, what's going to take it higher. And that's the good news for India, is unlike in the United States, where the cyclical stocks have been compressed to a relatively small part of the market. In India, the cyclicals are still a pretty chunky part of the market. So I think it can easily go up another 10% over the next couple of months.
Okay. The big move happened during the lockdown in this whole digital work from home space. The IT companies did exceptionally well. Now with the second round of perhaps lockdown or curbs across the globe, do you see resumption in this whole, in this pocket, like technology, for example? Do you see fresh money getting pumped into some of these larger names?
Well, they've certainly had a bounce because they kind of sold off when we got news of vaccines. They've bounced now. I think both growth and value will go up, but I think in relative terms, value will go up more.
Okay. Mark, the rush of money and the rise in share prices in November has been a bit, too fast, too furious. You're not still worrying about, red flags or bubbles?
I agree. I mean, the major benchmark indices like the MSCI World Index, the S&P Index, the Dow Jones Industrials, they're all up about 11 to 13% so far this month. So it should consolidate, but I think after that consolidation, they will continue to go higher. I think the trend, as I said earlier, with very low interest rates, but vaccine that we can see across the abyss, naturally is a tailwind for risk assets.
Okay, so for the rest of the, okay, we are already at the end of the year. For the new year, to 2021, what would your pecking order be in terms of markets?
So we have had our bets concentrated in the US and China for the last couple of years, and that remains unchanged. I think I would try to answer the question by saying over the next 3 to 6 months, I would own value and cyclicals. But if I was taking a 5-year view, I'd far rather have my money in these technology companies. And I'll give you a good example. I think it was last week or 2 weeks ago, Amazon announced they were opening a drugstore chain, pharmacy business. Online, obviously. Well, can ICICI just announce they're opening a pharmacy business, or any other Coal India or any other non-technology company? Of course not, because they don't have that ability to scale. So it's that scalability that is going to just cause increase in digitalization of the old economy. And some old economy companies will be nimble enough to reinvent themselves. And Walmart is a good example of a company that did that in the United States, avoided the fate of Macy's or Sears. But the real winners will still be the technology companies, because they are the best equipped to do these online businesses.
That's very useful advice, Mark. Matthew, pleasure speaking with you. Thank you very much. I assume that you also will take an extended break for Thanksgiving, and thereafter, have a great weekend.
Okay, that's the word coming in from Mark Matthews. So clearly there's more to go. It's a Goldilocks scenario according to him, and perhaps there could be more to go in this.
More in favor of the tech stocks.
Yes, because I guess there's a second wave as well going around the globe, and once again this whole digital theme is something that could take precedence. Let's take a quick break on that note, but many stocks in focus on the other side of the break, so don't go anywhere. Our entire team will be with us to prep us for the day.